Hello, this video is all about posting to the ledger from the general journal. And it will cover vocabulary, chart of accounts, example transactions, steps on how to do those transactions, and then it'll finish up with proving cash and correcting entries. So let's get started with page number 1 and vocabulary. A journal is a permanent record of the debit and credit parts of each transaction recorded in chronological order. However, a journal does not show all the changes made in a single account in one place. That's where a ledger comes in. A ledger is simply defined as a group of accounts, and a general ledger is a ledger that contains all accounts needed to prepare financial statements. The account title is the name given to an account, and the account number is a number given to an account. And a place you can go to find information about all the account titles and numbers is the chart of accounts. It's defined as a list of account titles and numbers showing the location of each account in a ledger. Accounts are arranged in the same order as they appear in financial statements. And so remember that all of these steps in the accounting cycle are linked. They're all in the same order for a reason. It's to keep accountants organized. So when you're assigning accounting numbers, you want to do that in tens so that other accounts can be added in between if needed. So for example, you'll do 110, 120, 130. That means you have accounts 111, 112, 113, all the way through 119 to assign new accounts if they come up. You want to choose the number in the middle of the current accounts when you're assigning a new one. For example, if you already have accounts that are numbered 150 and 160, and then you want to put a new one in between, you're going to make that one 155. So you still have room on either side of the 155 to add more new accounts if they come up. Our last definition here is file maintenance. It's defined as the procedure for arranging accounts in a general ledger, assigning account numbers, and keeping records current. Next up, we have page 2, and this is all about the chart of accounts. So you'll see a picture of the chart of accounts for X Ample Business here in the top. We're going to reference this a lot throughout the notes. What you need to notice first is on the left are the balance sheet accounts, on the right are the income statement accounts, and then they're further divided by category. So first up, the hundreds, we have assets. These are arranged in order of liquidity, and liquidity means how easily it can be turned into cash. So cash is always 110 because it's already cash. It's the most liquid. So you'll always start there, 110 with cash, and then you'll see 120, 130, 140. Those are arranged by liquidity. 120 is accounts receivable. That means a customer has purchased something from us but not yet paid cash. So that's going to turn into cash soon. So it's pretty liquid. Supplies, on the other hand, to turn those into cash, you would have to sell them. So they're less liquid than accounts receivable and cash. And then prepaid insurance, if you buy an insurance policy from an insurance company, you can't really sell that. So that is not liquid. You can't really turn that back into cash. That's why it's at the end of the assets list. It is least liquid. In the 200s, we have liabilities. These are arranged in alphabetical order. So we only have one liability in this example, but if there were more, they would be alphabetical. The 300s, those are owner's equity accounts. They're arranged in alphabetical order. Capital is always going to be first. Its number is going to be 310. And then after that, we have the drawing account. That is 320. On the other side, we also have owner's equity accounts. We've got our revenue accounts, which are in the 400s. These are all the accounts representing money brought in by business operations. Often it's just one account titled sales. However, sales can be further divided up, so you would number them alphabetically if there were more. Next, we have the 500s. Those are expenses, and those are arranged in alphabetical order as well. So we're going to go ahead and look at the chart of accounts up here, and we're going to use the rules for assigning account numbers on the previous page. So what numbers would you assign these new accounts? Accounts receivable purchaser. Where would that fall? If you look up at the chart of accounts, you'll see that cash, then accounts receivable. There's an accounts receivable customer already. So we're going to put it right after that because P comes after K. So we're going to label that right after accounts receivable What number would you give it? 125, because you want to put it in the middle of those two so that there's more room to add if you need to add others. Next up, we have accounts payable supply shop. So we're going to look at our liability section there and supply shop. So S comes before V. So we're going to go ahead and label that 205 because it's alphabetical order, and supply shop comes before vendor in the alphabet. Okay, advertising expense. If we look at our expenses, those are arranged in alphabetical order. It comes before insurance expense, so we're going to label that one 505. At this point, we're going to go ahead and pause to see if you can figure out the numbers for our last two accounts there. Utilities expense, miscellaneous expense, what would you give them? So go ahead and pause and see if you can figure that out. Okay, so utilities expense, we have 540. Miscellaneous expense, we have 515. Did you get it? Moving on to page 3, we're going to go over the steps for posting from a general journal to a general ledger. First, at the top of the page, we have opening a general ledger account. And to open an account, you simply write the account title and the account number at the top of the general ledger account. Posting is defined as transferring info from a journal entry to a ledger account. And this is beneficial because it brings debits and credits affecting each account together in one place. For example, if you want to know what's going on in your cash account, it is much easier to look at only what's going on in the cash account rather than trying to sort out where cash is affected in a general journal. So it makes it much easier to figure out what's going on in a specific account. Also, there's a separate ledger for each account, and it's organized in the same order as the chart of accounts, also same order as financial statements. Remember that accounting is all about the paper trail, and it's nice and neat and orderly so that you can understand where information's coming from and going to. Adding to that, you'll see our picture of a general journal and a general ledger example account here for supplies. You tie those two things together with the posting reference. It's abbreviated as postref in the columns here, and it serves 3 purposes. One is a post can be traced to its source in the journal. So if you look at our supplies account here, the postref column, you're going to put a note there in that postref column to show what page it came from in the journal. We tie the ledger back to the journal in the postref column of the journal. It ties those two things together. Again, it's all about being clear and transparent about where your information's coming from and where it's going to. It's nice and neat and orderly. The third thing that post reference does is it sort of checks off the entries once they're posted. Posting to the ledger consists of 5 steps. The first thing you do is you enter the date. Just like the journal, the first entry includes the year, month, and day, and then the rest just include the day. So you copy the date straight from the journal. Then you do the ledger postref. This is where the G is short for general journal, and the page number is included as well. So G1 is what you would write in the postref column of the ledger. Third step is to copy the debit or credit. It's literally just copying it from the journal. So far we're just copying date, page number, debit or credit. Those are all taken exactly as they are from the general journal. Fourth step is to calculate the new account balance. Now, account balances in the ledger always start at 0. You add the normal balance side, you subtract the opposite of the normal balance side, and you always record the balance in the normal balance side of the balance section. Now, if that's confusing, that's okay. We're going to go through a bunch of examples, so stay tuned. The fifth step is entering the journal postref. So you go back to the journal, you write the account number to which it was posted. In this case, again, it's 140. You're going to put that back in your general journal postref column for each row that you post to the ledger. Moving on to our 10 example transactions. These are found on pages 4, 5, 6, 7, and 8. On the top of page 4, you'll see a reminder here that we're going to use the 5 steps on the previous page to post each transaction. Please reference those steps, have those out, and look at them as we learn how to do each one here. So for transaction number 1, you'll see our general journal entry is there. It's on rows 1 and 2 of our general journal. We're going to take that information to post to the ledger. So the first thing we do is we go to our cash account in the ledger. So cash, you'll see we go to the cash account there, and then we follow our 5 steps. First step is the date. It is just taken from the journal. Second step is the post ref. This G stands for general journal, and it's page 1, which we have in the top right corner of our journal there. Then we copy the debit. So in row 1 of our general journal, it's a debit of $2,000. We just copy that down. So steps 1, 2, and 3 just copied from the journal. Then we figure out our account balance. Now remember, all accounts start with 0. So 0 plus 2,000 is 2,000. And we're putting it in the debit side because the debit side is the normal balance side for cash. Our last step for this row is to tie the ledger back to the journal with the post ref. So you take 110 and you put that back in the post ref column of the journal. Moving on to row 2, we find our capital account in the general ledger. Then we copy our date. It's general journal page 1, and this time it's a credit of $2,000. So when we figure out our balance, we want to go to the normal balance side of our capital account. And the business is smiling and it's under owner's equity. So it's going to be a credit. So we've got 0 plus 2,000. The balance again is just 2,000, but this time it's on the credit side because that's the normal balance side of this account. Lastly, we want to tie that back to the journal. The 310 goes in the post ref column on row 2 to show that we have posted it to account number 310 of the ledger. In the middle here, we have reminders that you're going to add the normal balance side, subtract the opposite of the normal balance side, and you want to record the balance in the normal balance side. A little trick here that you can see with the first 2 is the first post will always be the normal balance side. So our first post in cash was a debit. A debit is the normal balance side for cash. Under capital, the first post was a credit. Well, credit is the normal balance side of capital. So whatever the first post is in the account, that's going to be the normal balance side. All right, on the bottom here, we've got transaction number 2. We have supplies. So we go to the supplies account in our ledger. Then we copy our date, our page number, and our debit. It's a debit in the journal, so it's going to be a debit in the middle of the ledger. Then our balance, it started out with 0. 0 plus 300 is 300, and it's in the debit side because supplies is an asset, and the normal balance side of all assets is debit. Again, use that trick. Our first post is a debit. That means our balance is going to be a debit. Don't forget the last step, that is to tie that ledger back to the journal. So the account number is 130. You put 130 in the post ref column of the journal. Okay, moving on to cash here. We're going to copy the date, but remember, we don't need to do the month and the year. We just need to do the day. We also copy the page number, and now we copy the credit because cash is a credit in row 4 there of the journal. So now we're going to subtract the opposite of the normal balance side. So far, our account balance for cash is 2,000. We're going to do 2,000 minus 300, which is 1,700. And we keep our balance in the normal balance side. And we can't forget our last step, that's moving that ledger account number up to the journal. So we write 110 in our general journal post ref column. Moving on to page 5, we have transaction number 3. So we find the prepaid insurance ledger account and we record our date, G1 for general journal page 1, and a debit of $600. Prepaid insurance is an asset. The normal balance side is debit. So we're going to record the 600 in the debit balance. And then we're going to record account number 140 back in the post ref column of the general journal. Moving on to cash, we record our date, G1 in our post ref. It is a credit of $600. So again, we're subtracting. So now our account balance is $1,700 minus $600. Our answer is $1,100, and we keep that in the debit balance. Think of it like your bank account balance. If you look at cash, the debits are the deposits, the credits are the withdrawals, the balance is the running total in your account. The debit is representing positive numbers. This means that you put $2,000 in, you took $300 out, you took $600 out, your current balance is $1,100. And then we go ahead and put the 110 back up in the post ref column of the general journal. So posting from the journal to the ledger is continuing the paper trail. We started with our source document. We journalize those transactions. In the doc note column, we keep track of where we got the information from our source document. In the post-ref column, we say where we're sending it to. So we've got analyzing transactions with source documents, journalizing transactions, posting to the ledger. It just continues that paper trail. Okay, transaction number 4, we have supplies. So we go to the supplies account. We record our date, G1. It is a debit of $800. So now we're adding to our supplies. So we started with $300 plus $800. Now we have $111 worth of supplies. And then we'll take our account number 130 and we'll put that back up in the post-ref column. And then we'll move on to accounts payable, vendor. We've got our date, and because it's the first one in that account, we need to include month and year. We've got G1 for our post-ref in the ledger. It is a credit of $800, and accounts payable, normal balance side is a credit. It's a liability, so it's a credit, and use that tip. Our first entry is a credit, and so our balance then is also credit. Don't forget, the account number 210 goes back up in the journal. Here we are on page 6 with transaction number 5, and we purchased supplies on account from vendor for $800, and now we're going to pay $500 of that bill. So we find our vendor account in the ledger. We copy the date. It's April 15th. We copy our post-ref, which is general journal page 1. Now we have a debit of $500. So we charged $800. Now we're paying $500. So 800 minus 500 is 300. And it's on the credit side because that's the normal balance side of accounts payable accounts, which are liabilities. Then we take our account number 210 and we put that back up in the post-ref of our general journal. And then we move on to our cash account. So this time for cash, we include our date, which is the 15th. It's also general journal page 1. Now it is a credit of $500. And so we're continuing to take money out of our cash account. So $1,100 minus $500 is $600. And lastly, we have our cash account number 110 goes back up in our journal for transaction number 5. Keep in mind that all of these steps are linked together. It's all about that organized paper trail. Transaction number 6, we received cash for sales. So we go to our cash account. It is still the 15th. You can have more than one, and most businesses will have more than one transaction per day. So it's still the 15th. The date is the same as the previous transaction. We're still on general journal page 1. This time we are getting money. So it is a debit of $300, and we stay in the same debit balance column over there on the right. So 600 plus 300, now we have $900 in our account. And we take the 110 and we put that back up in the journal, and then we move on to sales. The business is smiling, it's owner's equity, it is a normal credit balance. So we'll copy our date, it's the 15th. If it's the first one, don't forget to put the month and the year. It's still general journal page 1, and it is a credit of $300. We record our $300 in the credit side of the balance column as well. Lastly, take our account number 410 and you put that back up in the general journal. Here we are on page 7 with transaction number 7. We have accounts receivable K customer. So we're going to go to that account in our ledger. We're going to copy the date, G1 for general journal page 1. It's a debit of $500, and accounts receivable is an asset. So the normal balance side is debit, and we will record it in the debit side of our balance columns. Then we will record our account number 120 up in the general journal post-ref column, and then we'll move on to sales. So sales falls under owner's equity, and the business is smiling when it makes sales. So the normal balance side for sales is credit. So we'll copy our date, our post-ref G1, our $500 credit, and now we're adding it to sales we've already made. So $300 plus $500, $800 is now our current sales, and we will take our account number 410 and we'll put that back up in the post-ref column. Okay, we have transaction number 8. This is where we paid rent. We paid $600 for rent. So we go to our rent expense account, and this also falls under owner's equity, but the business is frowning. So the business is not happy when it has to pay things like expenses. And so these are debits. So we have our date, G1, it's a debit of $600 because overall owner's equity is going down. And so we have a debit of $600 in our balance. Remember to use the trick. If it's a debit in the middle, the balance is going to be a debit also for the first post in every account. Then we take our account number and we move that up to our post-ref column in the journal. So it's 520. And can you explain why this is the account number for rent expense? I'll give you a tip. Go ahead and go back and look at our chart of accounts and see if you can explain why the account number is 520. Did you get it? So if we look at our chart of accounts, we'll see that under expenses, they should be arranged in alphabetical order. And so the reason rent expense is 520 is because it falls between insurance expense and supplies expense. It is common for businesses to add expenses over time. So remember those rules of adding new accounts. You want to make sure they're 10 apart. And when you add new ones, they're in the middle, just like we did at the bottom of this page. Okay, back here on page 7, we're going to go ahead and post our cash for transaction 8. So we go to our cash account. It's the 20th. It's G1. This is a credit of $600. And so now are we adding or subtracting? It's the opposite of the normal balance side, so we're going to subtract. So we take our current balance, $900 minus $600, and our current cash balance after transaction number 8 is $300. Now, if a balance gets too low, it could cause cash flow issues. So if you were the decision maker for this business and your cash was depleting in this way, what decisions could you make? I'm going to go ahead and pause so you can think and discuss. Okay, so what did you come up with for what you would do if your cash was getting low? Well, you could decide to not allow sales on account because we still have money that customer owes us. So you could not allow sales on account. You could watch expenses more closely. You could increase investments, increase promotion, but careful if it's paid promotion. By the way, what type of promotion is not paid? Word of mouth and unsponsored social media posts are not paid. You could also take out a loan, but only if you're certain it can be paid back. So there are some ways to combat cash flow issues, but keeping track of cash flow and keeping an eye on that is something accountants can do to make sure that business owners and managers can make the best decisions possible. Here we go with page 8, transactions 9 and 10. This is the end of our example transactions here. We're going to go ahead and pause, use the steps on page 3, use what we've learned on pages 4, 5, 6, and 7, and see if you can do these on your own. Did you get it? I'm going to go through them really quickly here. So in cash, it's the 26th, G1. It's a debit of $300, which is the normal balance side, so we're increasing. 300 plus 300 is 600 for our account balance. Our account number 110 goes back up in the post-ref column. Then we move on to accounts receivable. So our date, G1, it is a credit of $300, which means we're subtracting. So 500 minus 300 is 200. That means customer still needs to pay us $200, but they've already paid us $300 of their bill. We take our account number 120, we put that back up in the post-ref column, and then we move on to our next transaction. On the 29th, we go to owner drawing, and then we include our date. We're still on general journal page 1, so it's G1. It is a debit of $100, and that is the normal balance side for an owner's equity account that we're frowning. So we've got our debit of $100 in our balance section, and then we have 320 is written back up in our post-ref column of the journal. Cash, we go back to our cash account. We've got our date, general journal page 1, it is a credit of $100, so we're subtracting. So $600 minus $100, that means $500 is our balance for cash. 110 goes back up in the post-ref column of the journal, and that is the end of our example transactions. We're left with a balance of $500 in our cash account. Did you get it? Do you have questions? Our last page, we're going to wrap it up here with proving cash and correcting entries. So proving cash is defined as determining that the amount of cash agrees with the balance of the cash account. It can be proved any time to verify accuracy of records, but it should always be proved at the end of the month. So what you do is you look at the ending balance in your cash account, which is $500 here, and then you look at your bank records and you determine, is the balance in the business records equal to the balance in the bank? So you want to make sure that those match, and if they don't, you want to figure out why, and if there's a mistake, you want to correct that. Down at the bottom, our correcting entry definition is a journal entry made to correct an error in the ledger. So a memorandum is prepared describing the correction, and the memorandum is the source document for the correcting entry. So mistakes are made. Honestly, it's pretty common for mistakes to be made in accounting, but it is all about finding those and correcting them before moving on. In our example memorandum here, you'll see that on July 10th, a cash payment of $12 for postage was debited in error to miscellaneous expense. The owner signed it and they dated it July 28th. So what we do is we take the date, and it's the 28th, and you'll see here that we're on rows 12 and 13. So it's already understood that this is July because the first row of this journal page has July and the year. So we're just going to put the day 28. And then we are going to debit postage expense because we accidentally debited it to miscellaneous expense. It was meant to be debited to postage expense. So we're going to fix that here. And it was $12. And then since we accidentally debited it to miscellaneous expense, now we have to credit it to miscellaneous expense to take it back out. So our miscellaneous went up. Now we're taking it back out where we accidentally didn't put it in the first place. And then our source document is M2. You'll see the little number 2 up there on the memorandum. So again, mistakes are common in accounting. It is all about finding mistakes and correcting them before moving on so that your records in the end all match, are accurate, are correct. And then business managers and owners can make the most informed decisions with accurate data. Okay, so we've gone over vocab, chart of accounts, 10 example transactions following those steps of posting to the ledger. We've also finished up with proving cash and correcting entries. At this point, you can go back and color code, add any margins in the notes, ask any questions you have about specific parts. And I hope you found this helpful. Thanks for watching.